Hello, everyone out there in podcast land. Welcome back to Adventure Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on WeFunder, but also the different resource providers and mentors helping founders along the way. Huzzah! Today we have Waseem Daher, the founder and CEO of Pilot, which offers bookkeeping, tax, and CFO services for growing businesses. A serial entrepreneur, Waseem's first startup, K-Splice, was acquired by Oracle, his second startup, Zulip, was acquired by Dropbox, and his third, Pilot, achieved unicorn status when it raised its Series C last year. In this interview, Waseem drops wisdom on some of the lessons he's learned along his startup journey and the paramount importance of delighting your customers. WeFunder gang, take it away.
This is Jonny Price, VP of Fundraising at WeFunder. Welcome to another episode of Adventure Capital. Joining me today, we have Waseem Daher, CEO and founder of Pilot. Waseem, welcome to the podcast.
Thanks for having me.
Waseem, you are a serial entrepreneur. Do you like that name? Is that a title you embrace? Or
Yeah, I don't mind it. I mean, I think it's certainly the case that it's fun. If you ask me to describe myself, probably serial entrepreneur is the best I will come up with.
There we go. We'll roll with it. You're a serial entrepreneur. Maybe you could start by just talking us through some of the startup adventures you've had along your career and how you came to be running Pilot.
Sure. It's interesting, actually, because I think somewhat uniquely for us, all of the ventures I've been part of, all the ventures I've co-founded, it's effectively been with the same founding team. So it has really been a story of getting the band back together. So Jeff, Jessica, and I, my co-founders, we were all at MIT undergrad where we studied computer science. We were like in the computer club together. The whole thing was extremely nerdy. We worked on projects and class stuff together. And then our first company, which we did right out of school, was actually based on my co-founder Jeff's master's thesis. And we bootstrapped the company. We lived in a row house in Cambridge in Central Square. We ate a lot of ramen. We sort of could only spend money if we made money by selling our product. And the first company was called K-Splice. We had technology that could take software updates and install them without rebooting. I'm sure you've seen that pop up on your computer that's like, you must reboot. Mm-hmm. We had some tech that could take those and let you update the system without rebooting. And we sold it as a subscription service to IT admins. So that was the first company we did, which we ran for about 3 years. Oracle acquired it. We were at Oracle for a year and a day to kind of transition over the tech. And then we knew we wanted to kind of get started again. Basically, the next day, the founding team got back together. We said, okay, what's the next adventure? We set out to make a group chat tool for businesses. This was kind of a Slack-like product at a time when Slack was still making a mobile game. I would say good identification of the target opportunity. Obviously not the A+ on execution. It didn't become Slack. But Dropbox acquired the company. We were at Dropbox for about 2 years, kind of helping run product engineering.
Just to dwell on that for a second. Yeah, that's pretty interesting to be building Slack at the time, even before Slack pivoted. Why do you think, why didn't it become Slack? What do you know? Kind of these were the 2 or 3 things we got wrong in execution, or was it kind of a timing thing? You were a little early?
No, I think there are things we just did wrong, to be honest. And, no one can know, but certainly I have my own takeaways from kind of where I think we did well and where I think we did poorly. I think there are probably 2 things that I would have done differently if we could kind of hit reboot and do it again. One is I think we failed to appreciate just how important design is for B2B SaaS apps. And this is a comparatively new development, meaning 10, 15 years ago, the state of the art of what was great from a design or UX perspective in the enterprise was actually pretty poor. And the bar has risen there dramatically. And I think if we were to go do that company again, we really should have had an extremely strong design co-founder. So I think there was some design DNA that was missing. The second is a more philosophical point about workflow, which is in general, if you are doing something new, or I'm asking you to try my thing, I think one of 2 things has to be true about it. Either it fits into your existing workflow and you use it the way that you use whatever the alternative is, or we ask you to change your workflow, but it's clear very, very early on, ideally in the first 30 seconds, what the benefit of your changed workflow is. And at our second company, Zulip, I think we built actually a very, very compelling product. But the challenge with it is you really had to use it for like 2 or 3 weeks to get the hang of it.
Right.
And until you got the hang of it, it wasn't obvious why this was going to be so much better than the alternative. And so I think we really had a bit of a challenge from an onboarding perspective. I think you need to sort of have the light at the end of the tunnel visible at all times. And I think we actually, I'm proud of what we built, but I think we sort of missed the mark on that particular piece.
I signed up for Superhuman a few weeks ago, and it absolutely blew me away that it's $30 a month, right? So it's not nothing, but for a app that's, I don't know how many users they have now, but just kind of scaling so quickly, for them to take 30 minutes to onboard me, it kind of blew me away to that point on just kind of quality of onboarding experience.
And I think they probably have to do it in the sense that if you just like poked around yourself, you'd probably be like, I'm used to Gmail, never mind.
Exactly. It basically got me over the hump that I would not have gone over had it not been for the 30-minute onboarding. Exactly. And now I'm like hooked and going to spend $30 a month for evermore. So how big was Zulip when got acquired by Dropbox?
Not huge, like 12 people. It was a pretty small company.
Okay. And then you lasted at Dropbox for a little longer, looking at your LinkedIn for 2 years versus 1 year. So, a little bit more comfortable with grown-up corporate life.
I mean, Dropbox was a fun. I learned a lot of Dropbox. I met a lot of great people. I think we did really impactful work. I had a great time there, but I think for me, it's hard to get away from that itch of the desire to start something new or to do your own thing. Exactly. And so I think I never imagined it being my long-term home. I was like, cool, let's do it. We're going to learn a lot. We're going to have a lot of fun. We're going to build some exciting stuff here. But I sort of knew that there would always be another company.
Which brings us to Pilot.
And Pilot, and I think your listeners know this, we do accounting, tax, and CFO work primarily for startups of various sizes and stages. And it's born out of pain we had in our previous companies, which is when we were doing the first two companies, and I think for any founder or business owner of any kind, you want to focus all of your time on building the product or hiring great people or the specific kind of high leverage things that you excel at. And the challenge is that if you look at a lot of the back office stuff, whether it's accounting or tax or legal or HR or whatever, it's really, really important that it be done well, but it's generally not your area of expertise. And I think with Pilot, we said, well, listen, we can do this stuff super well, and we can talk at length about sort of how we do it under the hood, but we're sort of building the service provider we wanted to hire ourselves in our previous ventures.
Yeah. Can you say more about that? Like, what are some of the ways in which, you guys as founders with the two previous companies, struggled with, and what are the ways you've seen Pilot customers and other startups kind of struggle with bookkeeping and accounting? And then obviously, how does Pilot solve that problem?
Yeah, the challenge with it is this, which is it's important to get right. But as I mentioned, it's not an area of expertise of the average business owner. And so what you're really looking for, importantly, is not like a good how-to manual or like a good piece of software. What you're really looking for is a trusted partner who's going to be able to guide you through this stuff. And that's what Pilot is. When you work with Pilot, you're paired with your dedicated account manager and your team, full-time employees of ours that pre-COVID literally sat in our offices in San Francisco and Nashville. And this is all we do. We're the largest startup-focused accounting provider in the world. We work with thousands of startups of all kinds of stages. And so the good news about that is we know startups intimately. And so that means we can help out very tactically on things related to the bookkeeping, the accounting, the tax prep, budgeting, forecasting, et cetera. But we also just have a good sense of what the best practices are on pretty much all the back office stuff. And I think that's really where the magic is. We support you well now at your current size, but we can also scale and grow with you. And our larger customers are Series C, Series D, have a full-time finance team that we work closely with. I think one of the things we were looking for in our previous companies was a provider that could really scale with us. And that's sort of why we made Pilot.
Got it. you have raised a bunch of capital down the years. Can you talk a little bit about your experiences raising capital, I guess, for all three companies? I think you've had a diversity of experiences, right? Some bootstrapped, some venture-backed. Curious to hear on your take for each of those three companies.
Yeah, so the first company was bootstrapped. And I guess its initial funding was, we won this business plan competition at MIT called the MIT 100K. And then we got a government grant. We got an NSF SBIR grant. And that was basically the only external capital in the company. And other than that, well, we paid ourselves very little and we ate a lot of ramen and we all lived together. And it was, okay, well, if you want to spend more money on hiring someone or doing marketing or whatever, well, you got to sell some more subscriptions first. And I think that engendered in us a really kind of, I think, healthy and conservative approach for how to run the company. And I think just like some real respect for just the value of the dollar and the fact that, hey, you know, this stuff is hard earned. We have to spend it thoughtfully. We have to spend it in a way that's really going to drive business results.
I've listened to I think it's a YouTube video with Sam Altman talking, and I can't remember if it's 3 or 5 kind of top characteristics of founders that he looks for. I think it's 5. And one of them is frugality. And I remember listening to that, like, that seems like such a weird words to put in your top 5. But yeah, I guess he's kind of mostly talking about hiring maybe, but and sometimes, you know, it feels to me like, yeah, Nick, our CEO, like checks that frugality box. But yeah, it's I guess you kind of learned the value of that kind of the hard way, eating ramen on startup number 1.
Yeah, you know, it's one of these things where, like, you know, what can kill your company? Well, the things that kill your company are you give up or you've run out of money. Like, obviously we're being simplistic, but those are sort of the 2 things that kill your company. And I could talk at length about how to manage your psychology on number 1, but on number 2, I think like frugality is a key piece of it. And amusingly or interestingly, I was an intern at Amazon a million years ago, and frugality, I believe, is one of Amazon's core values as well. And for me, I think of it less as just like be frugal and a little bit more about like be oriented towards ROI. Like every dollar you spend every dollar you spend on thing A is a dollar you're not spending on thing B. It's like, how do we devote our scarce resources, which is our time and our dollars, toward things that are really going to move the needle for the business?
So that's startup number 1, bootstrapping, ramen. What about startup number 2?
Yeah, so for startup number 2, for Zulip, kind of right out of the gate, we raised some angel money. And we raised some angel money from folks, honestly, in our network from the previous startup, folks we had sort of connected with that had been following along. And so that was actually a comparatively quite easy journey in the sense that the folks who funded us already knew us, already had a high conviction in the team. And I think those early bets were really team bets. It was not business idea or opportunity necessarily. In fact, I think one of our early angel investors said, like, I don't like the idea, but I really like you folks. And like,
I mean, the fact that you guys just had K-Spice acquired by Oracle, right, is like you kind of almost
huge validation
in the pitch deck, right?
Right. I mean, and that's the thing, which is I think the calculus for our investors in the second startup were, okay, well, these folks kind of know what they're doing. They have a track record. They've worked together. Like, it was really a vote of confidence in the team. And then for the third company, it was really that, but just even more so, which is, okay, now we had 2 successful exits under our belt, same founding team, kind of getting the band back together. This time, like, aiming even higher, aiming even bigger. So I think, you know, confidence in the team's ability to execute, and the stages that the team had seen. Like, we knew about the early days. We knew about the later stage from our time at Dropbox. I think all of that was sort of very compelling and very interesting for our investors.
The 2 questions you had, or the challenges, execution challenges you identified at Zulip, right? The design and the kind of onboarding and kind of not showing the value enough early on, given that it's going to take you a few weeks to really get the benefit of the product. have you kind of applied them? I presume you've kind of then applied them at Pilot. Obviously, it is a beautifully designed piece of software, so we can check that box. But yeah, kind of curious about the onboarding, how you've kind of tweaked onboarding with Pilot as well.
Totally. So remember what I said is you need to do one of two things. You either need to meet the customer where they are. You need to ask them to not change their workflow, or you ask them to change your workflow, but you explain to them why it's better.
Fair.
And for us, importantly, we're doing the former. We're saying hire us instead of hiring the accountant you'd hire down the street. And in fact, functionally, the like kind of experience we're going to provide you is there's a person and there's a team and they correspond with you and we email you and we can get on calls with you and it's going to feel super white glove. Like we intentionally have said, we've said, listen, the problem you have is not that you want to buy accounting software. The problem you have is you want a trusted partner who's going to own this stuff for you. And so definitely the experience of Zulip, I think, dramatically informed how we thought about this. We said, we need to solve the problem end to end for our customers. And that's a little bit of a weird motion in the sense that for the average tech company, you think of yourself as in the business of producing software, not in providing a service. But actually, if you talk to our customers, the way that they think about us and the way they should think about us is, oh, Pilot is my accounting firm or my bookkeeping firm or my tax firm. Like that's who I hire.
100%. I always think about that with WeFunder, right? It's like, yes, we are a platform. Yes, we are software. But if someone raises, $5 million on WeFunder, they're paying us hundreds of thousands of dollars in fees. Like we got to be there for them, right? We've got to be able to pick up a phone and, be their expert kind of, advisor and kind of Sherpa through this regulation crowdfunding process. So yeah.
Right. I mean, I think what your customers are trying to buy is not a piece of software that helps you raise money. It's what they're trying to buy is I want someone to help me raise money under Reg CF or, who can help me navigate the process.
Yeah, exactly. So speaking of which, we chatted about this a little the other day, but curious to get your take. Like this community round concept is pretty new. It's a phrase that we've kind of almost stumbled upon the last couple of months, right? It's always been equity crowdfunding, investment crowdfunding. The exemption is called regulation crowdfunding. And only recently have we kind of come to this realization that actually kind of rebranding here is a community round, where you do an angel round, you do a friends and family round, you do a Series A, you do a community round where, maybe it's part of your Series A, part of your Series B, you're kind of opening up and allocating to your customers and community to invest. Imad, the founder of Mercury, which is a really great example, 120 million Series B from Andreessen and K2, and then opened up 5 million to their customers. What's your honest take? Pros and cons, like, can you see that, like, Web3 is about kind of, more decentralized kind of stakeholder ownership and engagement. Like we sometimes talk about this as like it's Web3 without the crypto piece, but genuinely curious on your take on this community round concept.
I like the idea in general. And the reason I like the idea is because if you think about sort of who you want backing your company, you want folks who are passionate and who are advocates and who will be evangelists for you. And who is a better evangelist than a customer who's a fan of what you're doing or someone in the community? In general, it seems to me that the benefits are numerous and the downsides are probably few, in the sense that I suppose the downsides are like the time and the cost, I suppose. But the benefits are potentially like, okay, you have a bunch of evangelists out there who are helping get the name out there, helping get the brand out there. It is something that we seriously considered doing in our previous fundraising round. We happened not to, but I think that was more a function of kind of expediency than a decision of, oh, we weighed the pros and cons and it didn't make sense. I mean, probably it actually does make a lot of sense.
I think the main downside right now is that you need to share financials publicly. So 2 years of gap financials reviewed by an independent CPA, reviewed by Pilot, perhaps.
Well, we don't do reviews, but we can prepare the financials.
Prepared by Pilot.
A different firm could do
by a CPA.
That would be fine.
but for whatever reason, some founders are kind of reluctant to share those financials publicly, right? And so that I would say is the biggest, and plus then the cost of like, because if your books have not been meticulously kept
Right.
up,
If you didn't use Pilot,
through the use of the Pilot software,
right,
then it might be a little more of a pain in the ass to get the review done or get the audit done. So that's probably the biggest kind of downside, I think, at this point. But yeah, well, that's encouraging to hear. You're kind of generally positive. I think we're seeing more and more founders of venture backed kind of hockey stick growth trajectory startups like Pilot looking at doing this, and also more and more VCs who seem very open to it, and not just kind of that then no longer kind of resistant, but even that they are genuinely enthusiastic and kind of are increasingly buying our thesis that if my portfolio companies bring on their customers as investors, then this might actually accelerate their growth, which is pretty good for me as the VC. Speaking of VCs, just to go back to, so you had those kind of three pretty interestingly diverse ways of raising capital for these three startups, right? Just kind of lessons or advice for founders, like, I mean, it's probably kind of too obvious, but obviously you choose the capital that's right for the goals that you have for the business, but kind of advice on, kind of the type of capital that founders should be going after, and kind of pros and cons to each of those three approaches that you raised through.
Yeah, look, I would say first of all that I don't think there's any one answer. I don't think there's a good way to fund your company and a bad way to fund your company. It is very company dependent, person dependent, stage dependent. Like there is more than one right way to do it. And I think in general, the calculus in any fundraise is, well, you sort of have a slider where one extreme of the slider is growth, and the other extreme of the slider is profitability.
Mm-hmm.
And the advantage of raising external capital is you can relax the focus on profitability and instead invest in growth under the thesis that ultimately that builds a business that is larger, more defensible, more enduring, et cetera, et cetera. But like we fully bootstrapped the first company. Again, we had the kind of grants in the early days and those were extremely helpful, but that was a very, I think, rewarding outcome for us and for the team, both in terms of what we built and also financially. And it's not obvious to me that that would have been an outcome we could have achieved had we gone the venture route or had we raised a ton of money. So I don't think your company is like better if it raises venture money. I don't actually care how the company is financed. I'm much more interested in, do people need what you're building and do they love it? And if they do, those are the elements that make your company successful. We just raised an XYZ round from investor ABC. Like maybe it's correlated with success, but it's actually like, I think less correlated with success than people think.
So is it like, when founders should go the kind of big venture route versus, on the other side, the profitable kind of bootstrap route? Is it like, if you're in a super hot competitive market and it's land grab mode, then go the VC route? Or is it like, it's depending on kind of the ultimate goals you have, and if you're kind of more intent on building a lifestyle business, then you kind of go the ramen route, or like, is there other what is the kind of question that the answer to which is basically, okay, it's this route or this route?
Sure. So first of all, I think venture capital is wrong for 99% of businesses.
Mm-hmm.
So what is the 1% of business that it's right for? Well, I would say if the total addressable market is enormous, like in the billions and billions and billions of dollars, and you're interested in building a large, iconic, enduring public company. If those are your goals and ambitions, and I don't think those are the right goals and ambitions for everyone,
mm-hmm.
then I think venture funding makes sense. The other thing you need to be comfortable with, though, too, is like the distribution of outcomes is pretty bimodal, which is for the VC firm, like you have 100 investments and your investment either like IPOs or it goes to zero.
Yeah.
And actually as a VC, like that's the name of the game.
And so you're pressurizing your portfolio companies to grow at potentially breakneck speed.
Yes, because a moderate success is actually closer to a failure.
Right.
Whereas for you, the founder, like that actually
Yeah.
may not be, you don't have a portfolio, you have your one company.
Mm-hmm.
And it is possible that an outcome that is a modest outcome by VC standards could be very life-changing for you personally.
Yeah.
Again, I really, really discourage people from fetishizing this idea of like, oh, I got to be a cool kid and raise VC. Like, no, for some businesses it's appropriate. For some businesses it's not appropriate. And that's not a bad thing.
Totally. There's this crazy gulf right now between basically VC, which to your point is a tiny, tiny percentage of the companies, the small businesses in America that started every year, and bank debt, which is basically zero risk. Okay, you don't need the loan anymore by the time you qualify for the bank loan. And there's this like huge gulf in the middle. And that's one of the things I'm personally excited about at WeFunder, is trying to bridge that gap. Right. And say, yeah, even if you don't have a $1 billion TAM, that's okay. Like, here's another option where you can raise from your customers and community. I'm curious about the growth that you've seen at Pilot, and kind of, we're obviously trying to grow WeFunder right now with 70 people. We 4x last year. I'm trying to, think, okay, how do we find more founders, and how do we grow the supply side of the equation? Generally, our model is a two-sided marketplace. It's like, if we find amazing startups like Mercury or Levels, then they're going to bring the investors, and so the supply kind of drives the demand side of the equation. But that's my challenge, is how do we grow this thing? So I'm kind of interested in two questions on how Pilot has grown over the years. One is kind of target audience, right? So it's like the 0 to 1 Peter Thiel thing, where it's like he started in Harvard, right? Or Facebook started in Harvard, and then they went to other Ivy League schools. Or this is like the crossing the chasm thing as well. So on the audience side, kind of the focus versus more diverse approach, and then also we'll come talk about the product features as well. But on the audience side, like, did you start with like Series A companies in these zip codes of San Francisco, and have a kind of super targeted kind of customer set, and then kind of expand from there? Or from the outset, were you kind of working, as you were saying earlier, from like very, very early stage all the way through to Series C?
No, it was basically more targeted in the early days, which is, I think, the companies where we had the most credibility were early stage technology startups.
Mm-hmm.
Then over time, as we've grown, first of all, our own capabilities have improved, and then our customers have grown with us.
Mm-hmm.
Like, the reason that we have the company that is Series C or Series D with 300 people or whatever, some cases
they sign them up in the seed stage.
Right. Usually it's because they signed up with us early. Sometimes they do come to us and they say, hey, listen, I'm not getting a good experience with my current provider, and I hear great things about you folks. And like, we do take them on sort of down the road. But in general, I am a strong believer of identifying a small niche where you can do a really, really terrific job, and then just focusing on that as a way of getting started. It is better to have a small number of really passionate users and customers than it is to have a large number of folks who are kind of ambivalent about what you do.
Any tips on how to kind of be disciplined there and explicitly not do the, because you're always getting kind of pulled, right? And you're getting pulled from customers. Hey, what about us? And there's always that kind of temptation. So how do you kind of stay disciplined?
It's tough. It's a tough trade-off, because you would, in some ways, the question is like, what is the smallest number of things you can do and do really well that will allow you to achieve your business's objectives? And if you can grow at the rates you'd like to grow, or whatever the objective is, while focusing on a super specific niche, and you can afford to continue doing that, like, it's not a bad thing. Usually the catalyst to get you to expand is, well, listen, we didn't start the company to do accounting for early stage startups. We started it because we wanted to solve the back office for every business out there. And so find what are the ways we thoughtfully expand beyond that initial mandate or that initial audience.
And so, yeah, I guess then, just as with on the customer side, you kind of start with a focused audience set. So on the product feature side, so what was kind of the first, product feature that you rolled out, and then kind of like, how did you kind of, extend into adjacent areas?
Yeah. Well, so look, the interesting thing about Pilot is, again, your experience of working with Pilot is you're paired with your account manager and your team here at Pilot. and they correspond with you. And every month we produce up-to-date books for you in QuickBooks. And so it's not like, we ship a feature and all of a sudden the capabilities totally change. Like you have this team who has your back. I think the kind of quote unquote features that we delivered are the ability to do more for you. So in the early days, all we did was the bookkeeping. And we added support for tax prep. And then we added support for AP and AR. And now we can help out with fractional controller work or fractional CFO work and help you with budgets and forecasts and da-da-da-da-da. Like, so it's really those capabilities, adding those capabilities are like the quote unquote feature for us. It's not like we added SSO support or like we added, Unicode or something. It's much more like, okay, now we can do more for you because you think of us again, when you interact with us, you're interacting with a real team of real people. You're not like clicking around a software tool. So it's like, fine, what can this team do for you that we didn't used to be able to do?
It was cool how you at Zulip, you talked about those 2 lessons you learned and maybe kind of execution challenges. The growth at Pilot's obviously been really explosive, fueled by, venture capital dollars, of course, but like, I'm sure you've obviously you guys have executed really well as well. Just kind of curious, like if those 2 were the lessons you learned at Zulip, any lessons you've learned along the way and, building Pilot and iterating and, kind of pivots or like iterations you've made on the model over the last, I don't know, what is it now, 5 years?
5 years. Yeah. We started the company in January 2017. I mean, I think the thing that I would have told you at the start of the company, which is still what I believe, is the North Star has to be delighting the customer. And there are 2 reasons for that. One is because you want to take pride in your work. Of course, you want to delight your customer. But the second is it's how we grow. Like if you look at where Pilot's customers 100%. Come from, it's like all organic inbound word of mouth stuff. And if the experience is good, your customers tell their friends. And guess what? If the experience is bad, your customers also tell their friends.
Yeah.
And that that can dramatically accelerate or dramatically slow down your adoption in the market. And it's tempting to get distracted and say, well, we need to go do X, Y, Z. It's like, well, no, if this is not going to make the customer's experience better, honestly, we probably shouldn't be investing in it.
There's this awesome podcast where Reid Hoffman interviewed Brian Chesky about the early days of Airbnb, and Brian Chesky was talking about the 11-star Airbnb experience, right? Which is, he goes through, it's a really awesome episode. I don't know if you've heard it, you should give it a listen if you haven't. But he talks about how the 11-star experience is like, you get off the plane in London to go to your Airbnb and like the Beatles are there, like playing a live show for you or something like crazy like that. So I love that, what you just said about like, delighting the customer, and that's like so central and so important. Are there kind of 11-star Pilot experiences, or kind of other kind of examples of customer delight that you've kind of discovered along the way? Like we started sending care packages to founders that raise on WeFunder, and so Cleveland Whiskey is this whiskey company in Cleveland, as the name implies, and so we send a bottle of Cleveland whiskey to WeFunder founders, and it's like that's just a kind of nice surprise and delight moment at the conclusion of the campaign. But what's the equivalent things you found over the years at Pilot?
So I think there are 2 categories of thing. One is just like the sort of nice stuff around the edges that makes the experience feel premium, like the examples you just gave. But I think for us, the real delight comes from actually solving like significant business issues for our customers, which is like, there are customers who are like, I'm getting acquired and I need all this help to do this diligence. And when Pilot comes through for you on that, it's like, oh my God, thank you. Like I was stuck here and you really delivered for me. Or, Pilot helped me raise that round of funding, or Pilot helped me close that deal. Like, I think when we're really able to drive business outcomes, that's sort of where the magic happens. Like, yes, the accounting is important. The tax is important. I'm not saying it isn't. It's critically important. But, when we can help make the business more successful, that's where the magic comes in. And if you look at the long-term vision, like, the 20-year vision for Pilot is we should run your entire back office for you. And when we do, we should run it better than anyone else. We should give you superpowers that you can't get anywhere else. Like if I could come to you and say, hey, listen, I know about 1,500 companies like yours in your industry and your geography and relative to your peers,
Right.
you're spending way too much on thing XYZ, and actually we can help you save 20% on it. Like, wow, you put real dollars back in my pocket.
Right.
Or if I can say, hey, you know, November is going to be really slow for you from a cash flow perspective. Like, we can help you get that WeFunder campaign up and running so that you can kind of weather the storm. Like, that's valuable. And so I think the true delight moments are, how do we make your business more successful?
Yeah, I really love that. That is an awesome note to end on. We have one more question that we ask every guest on the podcast. You've dispensed a lot of advice over the last 30 minutes or so, but one kind of explicit question of one piece of advice that you would have for a founder anywhere where they are along the journey.
I mean, look, it's trite to say, but it is a marathon and not a sprint. And again, I think there are two things that kill your company: you run out of money or you give up. And we've talked a bit about don't run out of money, but I think you give up is also a very real thing, which is you have to figure out how to make this sustainable for yourself. And that you got to work hard, but you also have to sort of be smart about it, which is you are playing the long game here. So you need to make sure that you're taking time for kind of all the self-care stuff you need to do.
One tip on self-care.
I mean, for me, it's like sleep 8 hours a night.
Like, sleep 8
make
hours
sure you're sleeping enough. Yeah, sleep, get some exercise.
I need to learn that lesson right now. 3 young kids is thwarting my ambitions on that front.
That would do it.
Well, cool. Waseem, this has been really awesome, man. Thanks so much for coming on the pod.
Yeah, of course. Thanks for having me.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you're ready, WeFunder's here to help. Be sure to like and leave a review, gang.